if you have $100K that's parked in
Sure.
your rainy day fund, that's $3,500 a year that you're not getting. Like $3,500 a year. I don't know about you, but I'd be happy to take
Yeah.
$3,500 a year with my money
Sure.
just sitting there doing nothing, right? Because I don't have to do anything. It's like $3,500. It's compounding every day.
If you start with $2,000 and put 10% and you average 10% yearly, which the S&P 500 has averaged 10% over the last 50 years, and in 40 years time, and every single month you put away $200, at the end of that, you will have $1.3 million, or call it $1.4 million. Now, everyone's going to say, well, James, yes, that's in 40 years time. I understand that. Obviously, you want to get your incomes, you want to increase your incomes because that's your biggest wealth building tool. But you want to be looking away and keeping, for the future. Because what happens if you get to 60 years old and you're like, oh, well, I didn't realize I'd get to 60 and now I've got nothing in the bank account, and you still have to carry on working. This is why, and you can leave stuff you can leave, money, generational wealth for your family.
What's going on, guys? Welcome back to the Challenge Accepted podcast. And today we have another episode, slightly different than the usual format, because today we're talking about investments and getting yields on cash. Diving straight into the topic with my homie James Bruce here. As usual, I'll be talking a little bit about the yield portion because this is something that I just recently rebalanced my portfolio a little bit. I was sitting on cash holdings. I like to hold a certain number of months of, let's just say, emergency cash on hand, right? Being an entrepreneur, being a trader, especially, you want to have a good, healthy buffer. My buffer is usually around 9 months of living expenses, just holding in terms of cash, like purely cash, easily accessible. That was always the priority for me, which was how soon can I touch this cash if I needed it, right? Like, let's say company's not doing well, like whatever reason, trading's gone to shit, right? Like if you are in a more highly volatile space, this is just a habit that I've developed as an entrepreneur for over, 10 years. Cause I've definitely had moments in time where like I needed to tap into cash reserves because, being an entrepreneur is volatile, right? So you have a lot of risk kind of on the business side. And it's the same thing applies to being a trader. So I was just always holding a bunch of cash, in different bank accounts, especially being a nomad. I don't hold a lot of money in Singapore. I was just using kind of like Wise, Revolut. There's different kinds of, regulations. For me as a Singaporean, there's rules around it. The Monetary Authority of Singapore is quite strict, even on these online banks. But I recently rebalanced my portfolio because I was like, I feel like this cash that's just sitting there is not really doing anything, and I wanted to look for options, for how I could get some yield. So of course, I went to my trusted financial advisor, ChatGPT, and we started to we started to research some potential options because I have a Wise account, I have a Revolut account, I have an IBKR account. For those of you that don't know IBKR, that's the broker that I use to buy and hold my long-term stock portfolio. I don't really have a stock portfolio. I have ETFs. Right, I have ETFs. I have exposure to REET, which is also the world real estate market. I have exposure to the bond market as well, small portion, and I have exposure to KWB, China, very very small portion allocation. But that's what IBKR mainly is for me. But what I discovered was if you have your margin trading turned on in IBKR, you actually get paid a yield if you're holding more than $10,000 worth of cash, and they do it via a very interesting mechanism. And this is what got me started down the rabbit hole of quote unquote safe yields. All right. So for those of you that are interested in getting a little bit more out of your money, if you have cash that's sitting around like me, you have emergency cash, right? Like 9 months of living expenses is this going to be a pretty sizable amount, no matter what, what you're doing. So to have that cash easily accessible being the first priority, right? I need to have it same day, or at most within 24 hours, I need to be able to touch and realize that cash in hand for spending. And a decent amount of yield is what I was looking for. And then this IBKR sweep is what started me down this rabbit hole. And then I started to realize that there are similar products across different banks. And the ones that I have looked into are, Revolut and Wise. So let me just take you guys through. I've had ChatGPT sum up, the products that I'm currently most interested in. I want to share this with you guys today for you guys to take a look at explain how the mechanism works a little bit because I've done my research into this and it's relatively safe and it's with insured banks and brokers. So if anything goes wrong, your money is insured. Like safety is up the top priority. We're not chasing high yields here. We're not looking for 10% plus, right? Like 3 to 5% is a very good rate for this type of money that I'm looking at, right? There's always a trade-off. More risk, more reward. Low risk, low rewards, but safe and stable, not volatile. So I'm gonna share my screen with you guys right now. James, if you can just pull that up and I'll go into the cash yield parts and then we're gonna get into actual portfolio long-term strategies that James is deploying. So we get both of these covered today, cash and stocks, equities, right? So the account that I'm currently mainly using right now, the account that I decided to park my money in is a Revolut flexible account. So this is an account that's offered within your Revolut banking service. If you use an online bank, you'll be very familiar with these types of like platforms, interfaces. So how they do it is if you deposit your money into the Revolut flexible account, Revolut uses money market funds like BlackRock and Fidelity into short-term US Treasury backed instruments. So they invest your money for you into very, very low risk short-term treasury instruments like T-bills, repo agreements, institutional deposits, right? So just like different instruments that are ultra short duration, right? 7 to 30 days, very low risk. And the yield is relatively high and it's very liquid because the products they're investing in are very, very short duration, right? Right now, yeah, go ahead, James.
No, do they tell you what they're investing into, or like how long do you have access to get that cash? Like how does that? Yeah.
So you can withdraw it anytime. Like you can immediately withdraw this cash into your Revolut account. They don't tell you
Sure.
exactly what they're investing in, but the interest on your account is paid every single day. So
Okay.
it's daily compounding. We all know the power of compounding, right? Like, but daily compounding is great because every day your account is just getting compounded. And if let's say you're depositing a fixed amount every month into your emergency cash savings just as a rainy day fund, your money is going to compound similarly to what you would get if you were investing in equity markets, which you should also be doing. But this is obviously on a much smaller scale, but some level of compounding is obviously great, right? Like because you're basically trying to fight or at least get yourself on par with inflation as much as possible because you know that if you keep your money in the bank with no yield, it's literally decreasing every single day.
Yeah.
Like your purchasing power is getting less and less, right? So you're trying to balance this out. So right now, ChatGPT says 5.21% APY. I'm on the app right now. I'm getting closer to 4.8%,
Okay.
but it's a daily payout. And this is for US dollars only. There's also Singaporean dollars, but I don't hold any Singaporean dollars, but there's lower rates here, but USD, if you do have access and hold USD within your accounts, you might want to consider using a bank like Revolut so that you can deposit this money in, instantly be able to take it out whenever it wants. And right now, yields are still very, very high, and Revolut takes a small management fee. I'm pretty sure if interest rates really start to drop and we start to go into a very low interest rate environment, maybe these yields won't be as good. You might see them cut into half, something like that. But for now, it's a great place to park your money, and that's where I have my money sitting there. 4 or 5% is nothing to scoff at, especially
No.
on a very, very highly liquid instruments that you can withdraw the cash at any time plus daily compounding. I think it's a no-brainer.
That's actually
I
interesting.
had no idea this even existed until I found out about the IKBR stuff, and then I started to look into, hey, like, are there alternative options? And this is what I found, right? Wise also offers very, very similar instruments. Again, invested in low risk regulated money funds, USD managed by Franklin Templeton, and then Singapore dollars would be managed by Lion Global Investors. So they would invest into these funds that then invest into the low risk, yield products, right? Underlying assets, T-bills, government and institutional bonds, high liquid repo assets, very, very similar mechanics. Yield snapshot is a little bit lower on Wise. We're getting 3.46%. This is the main reason why I went to Revolut because very, very similar services. I actually all my money for my rain day stuff was on Wise. I actually moved all my money over to Revolut because the APY is slightly better. And again, very similar, very safe. You can withdraw the money at any time. Again, take into account there's always risk involved. Okay, nothing is risk free in this world. But U.S. Treasury bonds, U.S. government backed, yield products are typically the safest, lowest volatility instruments that you can invest on in the market, right? They're not going to grow very much. You're not going to get crazy growth, but you are going to be able to take advantage of some of that sweet, sweet interest rate that's going on right now, especially in the environment that we're in today.
That's
So money
that's
market
pretty
returns.
crazy.
Yeah.
Just in terms of in South Africa, I've got where I keep some of like the cash reserves, money that I need instantly is in an Investec Prime Saver account that we actually get like 7% per year
Oh
on
wow,
it.
that's
Yeah,
pretty good.
pretty neat.
Yeah,
Yeah, but it is
that's
like private banking and that type of stuff. So it's probably why they give such a good rate. But yeah,
yeah.
that's
I
pretty.
mean, you guys have to always take into account, right? Like I first started doing like very degen yield farming. Like the concept of yield first came to me like through crypto. This was years ago, maybe like when I first got into crypto, like 4 or 5 years ago. And I was doing a lot of degen farming, like bull market stuff, just Ponzi schemes, fucking 300% APY on a token that has absolutely zero value. That's how I got into like quote unquote yield farming. But there's a lot safer ways to do it as well, without risk of your assets, well, with very little risk of your assets being completely uh destroyed, especially on very big licensed banks that are insured, right? So this is high safety, highest safety. I want to reiterate. So again, Wise has this very similar product, slightly lower APY as of right now. But even if you're earning, let's just call it 3.5%, right? Like if you have 100K that's parked in
Sure.
your rainy day fund, just like cash reserve, should anything go wrong, medical emergency, like family emergency, something catastrophic happens, like you just don't know. And if you have 100K in your safety net fund, right, that's $3,500 a year that you're not getting. Like $3,500 a year. I don't know about you, but I'd be happy to take
Yeah,
$3,500 a year with
for
my money
sure.
just sitting there doing nothing, right? Because I don't have to do anything. It's like 3,500. It's compounding every day. So if the whole idea behind the rainy day fund is essentially that you never want to have to touch it, right? It's just there as a buffer should anything go wrong. You never really want to or expect to use it. So you don't know how long you're going to be holding it for, which means this is the perfect type of yield for it, right? Lastly,
Yeah.
IBKR, for those of you that maybe can't get access to Wise, can't get access to Revolut, which will be very, very few of you, or maybe some of you guys already have IBKR accounts. It's a very, very big broker. I've been using them for my investments for many, many years now. I found out that they do this, what you call an auto sweep cash interest. The mechanics are a little bit different, but the idea is very much the same. So they sweep your idle US dollars if you have more than 10K into brokerage linked interest bearing mechanisms. Just a different way of saying they're going to invest your money for you, again, directly in T-bill repos, FDIC sweep accounts, margin lending mechanisms. So these are all just ways for you to participate in the IBKR ecosystem. For example, what does it mean by margin lending mechanisms, right? This just means they can use your cash because you've enabled margin. So
Yes.
firstly, you have to enable margin.
Same as a
All right.
bank.
Don't go and trade margin. Just enable the margin feature. They will be able to essentially loan out your money, right, to people that are using margin. So instead of taking a loan from the bank, you join them in being the bank. That's the very basic premise of this offer and the biggest difference between the IBKR side and the bank side, because the banks have no margin trading, right? IBKR is a brokerage platform. So it's a little bit different, but it's relatively speaking also very safe because they are licensed. They are one of the biggest brokerage firms in the world. They are insured. So you can probably relatively safely invest in this product or just enable it, and then they're gonna just use your money on low risk things. Again, the APY is pretty good here, 4.8 to 5.2%. Nothing to scoff at, right? And there is no interest earned. However, for the first 10K account, for many account types, you're gonna have to check this. That's another reason why I didn't go with them immediately, because IBKR is not really a place where I hold cash. It's not really a bank account. So I would need to go into my bank account, transfer it into IBKR, hold that balance there, and then it takes, again, 24 hours or so, maybe 1 to 2 business days for that money, if I ever needed to access it, to come out. It's not a deal breaker by any means. The yield is very good, but it is a little bit worse, in my opinion, than whatever is available on Revolut, especially given that the yields are
Sure.
very, very similar currently, right? I'm getting 4.8% on Revolut and it's instant. It's just on an app on my phone. I don't need to do like crazy bank wires or anything. But this is also potentially a good spot. The pros of this, I think, putting it on IBKR, I would say, is if you are a dip buyer, right? So if you actively manage your portfolio and, like James, we're about to get into this section where you take advantage of like big dips in the market, you know when you're going to buy, you're not just like passive only DCA. This could be a good option for you because all you need to do is just turn on the margin, right? So if you're actively dip buying, you're keeping cash, 20, 30, 40, $50,000 for dip buys, regularly funding your account, and you want it to be accessible to immediately invest, then sitting on a brokerage firm and collecting, 4.8 to 5.2% APY is pretty good, right? So, and all you need to do really is turn on your margin. Again, I would urge you to go and research exactly this on your own because I researched it for myself. I'm mainly a Singaporean citizen holding US dollars. So these are what's available to me. If your situation is a little bit different, you can look into if they have alternatives, right? Talking about safety and risk, funds are just sitting in your margin account, right? This is the most important thing. Your money is not moved anywhere. It's just you deposit it in to your account and it just sits there. They don't, your balance is always there. They're just giving you yield on it by you allowing them to use it for margin and stuff. All right. So IBKR again is not a bank. It operates under broker dealer rules, but it's still considered very secure for high yield cash parking. Okay. So you allow IBKR to lend your cash to institutions or sweep it into lower securities, and then you keep most of the interest. IBKR keeps a small spread. Again, slightly different mechanically speaking, but the overall logic behind these products is the same. So just a little comparison, right? Revolut flexible, 5.2, 3.4, 4.8. And yeah, risk very, very low. IBKR says low, maybe just a little bit more. And then there's a min balance. So you can see why I started off with my Revolut flexible. I'm depositing money in there. And then what I'm going to start doing is I'm going to start funneling money into the IBKR side, but that would be only dip buying money that I funnel on in there. So that's not even the DCA stuff, right? This is just like, cool, I've managed to have a budget surplus this quarter, this month, whatever it is. I want to invest this money, but stock markets are at all-time high levels. I don't really feel like investing extra right now. Let's wait for an opportunity. 20%, 25% dumps are not uncommon in the stock market. So
Well, we got
I,
that the other
I'd
day.
rather wait for things to go on discount, but my DCA still goes on, which brings us to the next portion of today's podcast episode. I would love for James, to take over here and talk a little bit about his investment strategy. We've covered the cash yield side. Let's talk a little bit about, how you approach the equities markets. How do you manage your portfolio? How do you even like buy? Like, how do you choose what broker? How do you choose which ETFs to buy, which funds? Take us through your process here.
Yeah. No, so just to keep it simple, I think everyone should have, like, if you're watching, Dave Ramsey, that he always speaks about like the 7 baby steps, to become a millionaire. Actually, it's a great book. Everyone should go and read that. But the first one is have $1,000 saved up as an emergency fund. So that if you don't have cash like a reserve, but what you just spoken about, like have cash reserves on, you probably shouldn't be investing first and foremost because
Mhm,
you need to have an emergency fund. Everyone should have one. So
mhm.
that's the first thing. But I just want to bring up this thing over here. So this is just if you started with $2,000. And just to say this, like I actually tweeted this the other day that not everyone should be trading, but everyone at some point should be investing or start investing. So
100% agree.
not trading is not for everyone. It can be extremely stressful. Some people don't have time to trade. They don't have the maybe trading is not. Do remember, trading is not for everyone. I'd say less than 10% of people are actually net positive in their long run. So,
I
um,
would say less than
you,
5, probably.
yeah, it depends on what who you're counting. Because I mean, some guys that start trading for 1 month and realize it's not for them. So, but I would say, I would say, yeah, probably less than 5. Anyway, everyone should be investing though. So if you just started with $2,000, so let's say you working at as an accountant, whatever the hell you're doing, every single month you can be putting away $200 a month instead of spending money on unnecessary things, eating out, which is flipping expensive, eating out, buying new clothes, stuff like the unnecessary stuff. If you started with $2,000 for 40 years, right? In 40 years' time, I'll be 66 years old, which would make, or 67, that's kind of like a retirement age, call it give or take. And if you start with $2,000 and put 10% and you average 10% yearly, which the S&P 500 has averaged 10% of the last 50 years, and in 40 years' time, and every single month you put away $200, at the end of that, you'll have $1.3 million, or call it $1.4 million. Now, everyone's going to say, well, James, yes, that's in 40 years' time. I understand that. Obviously, you want to get your incomes, you want to increase your incomes because that's your biggest wealth building tool. But you want to be looking away and keeping, for the future. Because what happens if you get to 60 years old and you're like, oh, well, I didn't realize I'd get to 60. Now I've got nothing in the bank account and you still have to carry on working. This is why. And you can leave stuff you can leave, money, generational wealth for your family. So this is just some of the ETFs that I've looked at personally. So obviously being in South Africa, I use Investec, or a lot of guys like using easy equities, but you can use IBKR. You can use in globally. Find the best platform that obviously is regulated. I use my banks. I think a lot of banks offer great stock buying accounts. And in South Africa, I personally like the Satrix funds. So the Satrix S&P 500. So it's basically, it mimics the S&P 500. The S&P 500 is the core of my long-term holdings, and then the NASDAQ funds, and then maybe like some world feeder funds that might involve like emerging markets like China, Queb and China and maybe India and, the Asian countries and maybe some, some South American countries, that type of stuff, right? So you can actually see over here, if you come to TradingView, this is all free, obviously. If you come to TradingView and you can see in the last 5 years, this fund, the S&P 500, has actually done 112%. So if we take 112, okay, 112 divided by 5, that's average 22% a year. Obviously, that we're going off this chart, we're going on averaging 10% a year, which is done in the last 50 years, because not every single year is going to be positive.
Yeah.
And the
the 10% average accounts for also down years, right? Like the average over 50
course,
includes, like, it's not just up every single year. There are
of course, 100%. And that's the thing. That's the problem, is guys do it for 6 months and they're like, oh, well, I've only got $2,200 in it, or whatever it is. And I'm like, yes, dude, that it's time in the market. It's not timing the market. So, you just got to carry on doing it. I mean, look at this. If you just start to like, if you did this $2,000 by putting $200 into the S&P every single year, or to vehicle that portfolio that makes 10%, after 10 years, you'll only have $46,000 in it. That's not a lot of money after 10 years. But after 20 years, you'll have 166. Now look where it starts at. After 30 years, you'll have 500,000. And then after 35 years, so just from 30 to 35, you'll literally double, almost double, 824,000. So that's where the magic starts to happen, the compound interest. Albert Einstein said it's the eighth wonder of the world. He who understands and earns it, he who doesn't pays it. So that's kind of my strategy. What I do is every single Friday, actually, I just put money into the long-term portfolio. So that's my strategy and what I do. But and I keep it simple. I don't try and pick and choose stocks.
Yeah.
I might play around and buy like a Tesla stock every now and again, but like with not most of my stuff is just going into ETFs, because I don't have to manage it and watch it. Whereas stocks, we have to actively, like, geez, I'm up 20% on this position, I need to take some off the table. Whereas like if you're in an ETF, it's more stable. So that, as I said, I don't think everyone should be trading, but I definitely think everyone should be investing.
I think that the approach here, taken for those of you that maybe aren't familiar, or those of you that are getting to trading, maybe a little bit confused between like, hey, like, how should I manage trading versus investing, right? It's helped me by looking at my money and my allocation as separate buckets, right? So the bucket that I talked about was this easy access, low yield stuff that, it's not like cash in my wallet necessarily, right? But it's available to be deployed. And you need this first. Everyone's like, oh, like, invest as soon as possible. Yes, invest as soon as possible, but you also need to take care of like real life situations. Even if you work a job, you could lose that job, right? And maybe you spend 3 months, 4 months, 6 months looking for your next thing. The last thing you want to have to do is, if you losing your job coincides with a tremendously poor market condition, you don't want to have to liquidate your stock and investment portfolio at a loss to fund your living. Like, that's the last thing that you want to do. Like, it's just, you don't want to be forced into that situation, right? You want to be able to be in a place where you can say, hey, like, I have plenty of money saved up, right? And that's going to take care of any type of downturn potentially. And the best thing is to have even more buffer to say, hey, if there is a downturn, I'm going to continue
I'll buy.
investing in stocks
Yeah.
because I want to be a buyer. And that's when you're going to see those returns. For you to average a 10% return on the equities markets, you cannot stop buying. You have to realize that, right? Like the biggest gains for where that 10% average is going to come from is going to come from you buying the bottom, not you timing the bottom, but you just consistently buying. And with the market's at a bottom for fucking 6 months, like you've been buying all that 6 months. That's where those returns come from. They don't come from you
Agreed.
buying the top, right? Like from top to top, it's a very small return, but from bottom to top, it's a huge return. So that averages out. So you need to make sure that you have the ability to continue buying regardless of your life situation. That's where you want to get to. And that's why having this first layer is so key and so important.
And just to put this out there, I do have my bachelor's degree in finance, so I'm verified to talk. No,
Okay.
but you
Because
should
we all know that university is not a scam or anything, you know?
we should no, come on. So you should go to your accountant or financial planner though, because everyone's got different goals as well. Some people have a higher risk tolerance, so there's different ETFs that could be that's suiting you. So some people want lower risk. So everyone has different goals, everything. So you should go to a licensed professional to go and speak to them and you specifically.
And one very important thing about ETFs and investing in equities is you really want to take a look at the fees because the fees can vary wildly. All right. So for example, I think on the China stuff, I'm paying a much higher fee. I think it's like 0.5 or even something like that, around 0.5% a year, which for an ETF is a lot, or an index fund is a lot, right? These are supposed to, like, most of the funds that you're getting to should be like less than 0.1% fee. Like that's kind of where you want to sit at because you don't want your money to just be eaten away. So there are sometimes different funds and different ETFs that are very similar, but one charges a much lower fee. For example, QQQ is the main ETF that tracks the NASDAQ, but I know for sure that there are alternative ETFs that offer basically the same coverage and the same exposure, but for a lower fee, and you should always go into that. So that's something that you should go and research, which is like the management fee that a particular ETF or an index fund is charging so that you're not just shafted on the rates.
Yeah, agreed. That's actually a good point.
That's the main outlook. I really wanted to bring this episode to you guys today because this is something that I've just recently done. I've just discovered these new yield products, and I'm like, okay, cool. I'm going to park my money there. Did some rebalancing, and I thought that this would be a topic that's interesting. You know, I actually told James about these products I think last week, and then I think that it's interesting for those of you guys that maybe haven't looked into yield products, haven't looked into investing before. Today's episode's all about that. I think that we should end this episode with the premise that everyone should be investing, but make sure you take care of that buffer first. I've made that mistake before. Okay, like I just like really aggressively investing and then not taking into account volatility of my life, and I've had to sell stocks or like liquidate positions in order to like fund a rainy day fund where I'm not really receiving much of income, for a couple of months, and I have to tide over. So don't make that same mistake as I am. Build that buffer first and then invest what you can. Obviously, the goal is for you to start to invest more and more, take advantage of that compounding effect as we go into the later years, right? So you want to start as early as possible. But I think what we've brought to the table today is a more safe approach to that. Take care of your cash, get some yield on it, and then go invest in China. Anything to leave the viewers with before we sign off for the day?
You told me on stream the one time to invest in China Quib, and it went down like 10%. So I said, I put my whole house on it. No.
Again, not financial advice. Okay, just telling you guys what I'm doing and what I would do. This is exactly what I'm doing right now. So if you go and bet the farm on China and you lose it, do not leave a comment below. For those of you that are still here, please like and subscribe on this video, and we'll catch you in the next episode. Peace.
Yes, sir.